Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's the top sales ideas for 2013, and on today's show, how to sell life insurance in a low interest rate environment. And with me is top of the table and MDRT platform speaker, Tom Hegna. Hello everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome, Tom. Day
Thanks,
4. Man, we're just talking about this and talk about a low interest rate environment. Every time I talk about it, it's usually from the carrier point of view. Well, this is why we have problems investing. Our interest rates, our current company practice interest rates are kind of low. We can only buy so many options with our index for our index products. Right. But we're kind of reversing this. Hey, the client says, I have a death benefit, and my death benefit came in, and I want to be able to try to live off that. But the interest rates are so low. In the old days, this was not a problem.
Right.
I mean, you get $1 million contract here, making 6-7%.
Right.
And you never have touched the principal. You live on it. Right. This is not the case. No. Talk about the environment. Talk about the impact of life insurance and how we can correct this, because the human value of income is the issue here.
Yeah. So I would say this. People have no idea how underinsured they are in this low interest rate environment. In fact, let me be so bold as to say I believe everybody watching today is underinsured for life insurance in this low interest rate environment. And here's what I mean. How much life insurance do you need in a 1% interest rate environment to protect $50,000 of income? The answer is $5 million. Well, how many people do you know that make $50,000 a year have $5 million worth of life insurance? And how many people watching that are making $200,000, $300,000, $400,000, $500,000 have $20, $30, $40, $50 million worth of life insurance? Now, some of you say, Tom, that's ridiculous. Okay. How much life insurance do you need in a 5% interest rate environment to protect $50,000 of income? The answer is $1 million. That's not ridiculous. What I'm saying, Steve, is I believe every single person out there needs at least $1 million for every $50,000 of income. Mm-hmm. Now, let me tell you a true story. And this happened to me in the month of June. I had been gone for a week. I spoke at MDRT. I was gone the next week. So when I left my house, I was gone for 13 straight days. I had to do laundry on the road. I came home for 1 day, and I left for 6 days. So you can imagine what my one-day Saturday looked like. I had 2 weeks of expenses. I had to get ready for the next week. I got a wife. I got 4 kids. They want to see their dad every once in a while. And so my day was packed. Well, I got a call from my oldest boy, Ryan. He said, Dad, I need a favor. My best friend's brother died a few weeks ago, and his wife, the widow, just got her death claim check, and it's pretty big, and she wants to talk to you. And I said, why does she want to talk to me? I don't sell anything. He goes, that's why she wants to talk to you, because she knows you know this stuff and you're not trying to sell anything. Well, I knew the family. I didn't know this widow. And I said, Ryan, I can't drive around town looking for somebody I don't even know on a day when I don't have time to do it. But I said, here's what I'll do. If they want to come to my house, I'll meet with them for an hour. Well, guess what? The widow, the brother, and the dad came and sat at my dining room table. She was 47 years of age, 2 little girls. She got $1 million death claim. And after I gave my condolences and sympathy, she said these words, I never thought I'd be a millionaire. Now, here's what I want to do. I want to build a custom house on a lake with a place for my daughters to play. And I literally had to stop her mid-sentence and say, time out. $1 million in a 1% interest rate environment is only $10,000 a year. Maybe you can get 30, maybe 35, maybe 38, but every expert I know says you cannot take out 4%. So she's looking at $38,000 a year for the rest of her life, and she was shocked. She said, what are you talking about? My husband made $250,000 a year. I got $50,000 of expenses on my table. I can't live on $38,000 a year. Now, what if he had followed my advice of having at least $1 million for every $50,000? What's the minimum somebody who makes $250,000 should have in life insurance? Minimum $5 million. Now, if she'd have sat down with $5 million, could we have had a totally different conversation? See, people have no idea what the low interest rate environment has done to their life insurance.
I think they also don't think in this term of generating income off a life insurance proceed. I mean, honestly, I'm just trying to think of the normal consumer. I would say the majority of our security advisors probably are thinking, well, I never really thought about it from income. I'm paying off indebtedness, future obligations, charitable intent, legacy planning for children and grandchildren, but I didn't really plan on trying to replace income off this death claim.
But it really had to, because he was the income producer for that family. She was raising the kids. He was making the income, $250,000 a year. And now that's gone. That has to be replaced. What is she going to do? She can't live on $38,000. So I mean, it was a really tough situation. But the key is people need more life insurance.
Well, let's say everybody buy the thinking. We definitely want to take care of our debts. We want to take care of our obligations. At any charitable intent, I want to do a little legacy planning, maybe even some replacement of his retirement income, which is now gone. Right. Is your boilerplate? I thought I heard you say this. You know, 50,000 chunks of 50,000 need what, $1 million
$1 million
to match up. So when we think about indebtedness, I think people say, hey, I just did $500,000, I paid off my mortgage, I can do all this, and I'm done. But we're saying add another million per 50,000 of income to make sure that you're okay, because the interest return is so low in our environment today.
Yeah, well, I mean, they were paying off their mortgage, they were paying off their debt. So what I'm saying is if you don't pay off those things, if you're just replacing the income, you need at least $1 million for every 50,000. If you pay off all the debts and you pay off all that, maybe you don't need as much. Maybe she didn't need 250,000 of income if all the debts were paid off. But if you do all the math on all of it, whether you do pay off the debt or the income, it's going to come down to you need at least $1 million for every 50,000, and that doesn't even fully do it because you can't get 5% guaranteed out there right now. Maybe 3.8.
Well, I want to go back to your thought when the policy beneficiary said, I have $1 million, and she already has blueprints on her dining room table ready to build the house of her dreams. Yeah. And you had to kind of pop the bubble here.
Well, because I don't think people have really any understanding of what this low interest rate environment means for income and for how would you live the whole rest of your life then? You know, how are you going to get income for the rest of your life? You need to have income. You know, people think that the world is all about assets. I got news for you. It's not about assets. Assets can be lost, they can be stolen, they can be sued, they can be divorced, they can be swindled, they can be decimated in a market crash. Retirement is all about income. And when you get a death claim, if you're a widow or widower, you are essentially put into retirement early because you need help with income for the rest of your life. It's not about assets. It's all about income. And I would argue guaranteed lifetime income.
So how old was this lady you were
47.
talking? 40. So she's a young lady, really, on the big scheme of things. And she not only needs future retirement at age 65, 70 when she started, but I need to get there, this gap between 47 and 65.
She had 2 girls to get through college, weddings, all that.
It's all matters. When we come back from the break, we're going to continue our discussions about how we're so underinsured. It's a crisis really right now among policyholders. And don't forget, you can view more of Tom's thinking right on his website, tomhegnaondemand.com. And while you're online, sign up for your own 30-day free trial offer for Backroom Technician. Just go out to brt.now/trial-signup.aspx. We'll be right back right after the break with more from Tom Hegna on low interest rate environment and how we need to protect our underinsured positions. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back. I'm Steve Savant with Tom Hegna, and remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right out on ashbrokerage.com. Just go out to the show, hit the logo right on the homepage, it'll take you right out there, and just heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about the underinsured crisis, and it is a crisis because we have people that are having, I don't know about you, Tom, I've delivered about 3 to 4 death claims. That's not really a lot, but 3 or 4 death claims in my experience.
Right.
And when I delivered those death claims, everybody's happy. And you would have thought, and my first one was when I was a young agent, so this is way back 30 years. $250,000 to a widow, but she was 23.
Right.
I thought I did her a favor. You know, I'm the only guy come with a check at the funeral. I see it now, and I'm going, I did not know the issue of human capital.
Right.
But I've noticed that carriers now are starting to insure this issue of human value or human capital, and they understand that even if I have no assets, you said it's not about assets, this is the perfect reason why it isn't.
Right.
Talk about that.
Okay, so there's been a lot of study around this whole human capital. Big companies like New York Life have done studies, Ibbotson, Morningstar, there's been a lot of research around it, and really what your total economic wealth is combined of 2 things, your human capital and your financial capital. Now, your human capital is the present value of all your future earnings. So let's say you got a brain surgeon who's 32 years of age. They may have no assets, but their future income could be, $100 million. Well, that's their human capital. So when you add your human capital to your financial capital, you get your total economic wealth. And for years, people only talk to people with financial capital. How much money do you have? How many assets? How big is your 401k? And what the new research says is no, you really need to look at human capital, because there's only one thing that can protect your human capital if you were to die, and that's life insurance. So there's no stock or bond or other investment that can protect your human capital, only life insurance. Your financial capital, you can buy insurance on things. You know, if you die, your stocks go to your kids, your bonds go to your kids, your CDs go to your kids. But if you die, your human capital goes away. Only life insurance can protect against that loss.
Now, I've noticed that and listen, correct me if you think I'm shorting us. I think the industry at large right now is somewhere between 15 times income to 20 times income. So if I don't have assets, and I'm a young doctor, as you've just described, they're going to look at my six-figure income and say, okay, 20 times that number can now be used as a death benefit to replace that income. Do you see that? Is it higher than that, or is that right in the game there?
Yeah, and I've heard some companies are lower than that. But see, if you think about it, back when interest rates were 9 and 10%, they always said you need 10 times your income. Well, that makes sense. If you're making $100,000, 10 times is $1 million. $1 million invested at 10% is $100,000. It's perfect. So if interest rates are 10%, you need 10 times your income. But interest rates aren't 10%. At 5%, you need 20 times your income. At 1%, you need 100 times your income. And so when you say 15 to 20, that means insurance companies are basically assuming that you can earn between 5 and 7.5%. We'll go out and try to find that guaranteed for the rest of your life.
Well, they can. And
right.
so I guess I'm asking you, do you think carriers are now wise to this? They understand it, and they're now starting to look at this as a standalone issue for death benefit? Because, you know, we have to justify our death benefit amount sooner or later. Are they looking at this and saying, this is an add-on to everything else we're talking about?
Yeah, and they should be, because one of the things when I go out and I say you need at least $1 million for every 50,000, you know, there's underwriters go, oh man, this guy's going to cause me problems because now they don't, at certain companies they won't give that. But I say those are the kind of problems we want, and sometimes we've got to drive it from an advisor point up to the company and say we need to have more life insurance because we've got to adequately cover these people.
Now, on yesterday's show, we were closing out the show, and I just remarked about some of the strategies that we use, and one of those strategies is legacy planning for children, grandchildren, you know, maybe charitable intent for your favorite charity. And we're looking at numbers. I look at the second to die. There's some leverage to that, because let's say the underwriter goes $1 million, 50,000. Maybe you think that's a stretch, but $1 million second to die might be a lot cheaper, and is he going to be okay with maybe using that as an idea for legacy planning and charitable intent?
Possibly, especially for grandchildren or children. But, you know, a lot of people think people over the age of 60 don't buy much life insurance, and that's not true. People over the age of 60 buy more life insurance than people under the age of 60. So just some things that advisors might want to be aware of. Number one, go out and talk to them about their grandchildren. See, people might not like their kids anymore, but they like their grandchildren, okay? And you'll come across a lot of people that have some money just sitting around, lazy money. They say it's just my in-case money, but I name my grandchildren as beneficiaries. Well, if that money went over into a life insurance policy, and many times these life insurance policies now have a lot of liquidity for older people, sometimes even have a money-back guarantee, but the leverage that they give on guarantees to the grandchildren as beneficiaries can be 2, 3, 4 times what it was in a CD. So giving money to grandchildren is a great place. Protecting Social Security benefits. You got a husband, he's getting $2,100 a month, the wife's getting $1,100 a month. When he dies, she gets his, but what happens to hers? It's gone. Well, can they live on one Social Security check? If not, why not buy a life insurance policy? And there are policies out there called a first to die, Steve, where you do husband and wife. First to die, that's perfect for protecting Social Security benefits.
Yeah, I don't think people understand this. There's this, you're actually, the surviving spouse in Social Security is picking up her, in your example, her husband's number. Right. And that number is less than what she's used to. Right. And she says, how am I going to live on this? And by the way, it may even shoot her into a higher bracket for all I know, because there was 2 lives, now it's only 1 life, and she's filing with 1 person. Right. So there's some real issues here to talk about Social Security protection. It's kind of like Pension Max, only for the government program of Social Security. I think this is what we need to start looking at. These are the menu of issues that we should be looking at in low interest rate environment to protect human capital and add that on to all the other things that we do when we sell. Well, that's our show for today. Remember, you can read all my online insurance news commentary, advisor blogs, and articles on Producer's Web, and all my answers to consumer questions on theinsurancelibrary.com. And don't forget, you can view all our past episodes on our on-demand section located at downtobusiness.ashbrokerage.com. So follow me on Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. Steve Savant for Tom Hegna. We'll see you tomorrow.